When considering a reverse mortgage, you're going to be faced with a decision that most folks think would be a really easy one to come to, but is not as simple as you'd think. Just like many mortgages out there, you'll have the option of a fixed interest rate reverse mortgage or an adjustable rate one. And more times than not, when I initially discuss this with clients who may not know anything about this loan, the immediate response I get is fixed rate, of course. Now, if this were a typical mortgage, that would probably be the end of the discussion. And really, most people aren't even discussing an adjustable rate traditional mortgage at all. But this is not your typical mortgage. With reverse mortgages, there comes some undeniable major benefits with the adjustable rate option that for most, they can't discount. So in today's video, we're going to break down the differences between these two options, and I'm going to give you some insight into why most reverse mortgages are adjustable rate. That way, if you decide to continue looking into this product as an option for yourself, you'll be ahead of the game. Hey everyone, Taryn Proctor here with Retirement Home Equity Advisors, your go-to resource for reverse mortgage education. If this is your first time with us, welcome. And if you came here looking for reverse mortgage insight, you have absolutely come to the right place. At REA, we specialize exclusively in reverse mortgage financing, and I produce educational videos like this just about every week to help you further your knowledge of this product so that you are better positioned to make the most well-informed decisions about this type of financing. So if you find this video helpful, give us a thumbs up and be sure to subscribe to the channel. You'll find many more reverse mortgage education videos on our page that I'm sure you will find helpful. And don't forget to also hit that notification bell as well when you subscribe so you get notified when my new videos come out every week. Alrighty. Now, before I get moving on today's video, I just want to impress upon you why this topic is so important. There have been multiple times that I've received calls from folks who either already spoke with another company and got a proposal, were already in the middle of a reverse mortgage transaction with another company, or folks who have already had their reverse mortgage for a period of time. And after speaking with them for a bit, it was clear that they did not understand or were not aware of what type of loan they had, adjustable or fixed. Now, whether that's because they simply just didn't understand, they misheard, or were not educated properly to begin with, I can't be sure. But no matter what, you should always be aware of and fully understand how your loan works or how the loan that is being proposed to you works. There are very distinct characteristics of each of these loan types, and you'll be able to discern after watching this video which is which. Secondly, this video is important because of our history with the adjustable rate mortgage and the immediate fear we feel when that topic is brought up. When discussing this with clients for the first time, I'm sure it makes people uneasy to hear that I think they should consider both the fixed and adjustable rate options. But on my end, I do so only because I would be doing folks a disservice if I didn't give them all of their options. So this video will help as far as putting that uneasiness to rest and having a clear understanding why it's important to consider both options. But also know that at the end of the day, the decision is yours as to which option you are most comfortable with. So don't ever let anybody tell you any different. Okay, so let's begin with the general differences of these two options. There are three main differences. Number one is, of course, the interest rate. One is fixed for the life of the loan, and the other can adjust. And at the moment, it can adjust on a monthly basis. Second is the amount of money you can receive from each option. In most instances, the fixed rate option will provide you with less proceeds than the adjustable rate option. That is not always the case, but in most. And third is the line of credit feature. The fixed rate option does not come with a line of credit feature. Only the adjustable rate option does. And as you'll see shortly, it's because of that line of credit why the adjustable rate option becomes much more appealing to most people. Now, let's break each of these down one by one. But before I do, let me just prepare you. We are going to be getting into some of the more complex aspects to this loan. So if you are in the beginning stages of your reverse mortgage research and some of this stuff doesn't make sense to you right away, I would highly encourage you to check out my channel and watch some of my other videos, as there is so much more to learn. Now, the fixed interest rate is fairly easy in that the interest rate is fixed for the life of the loan. It is never able to adjust. Many times, this fixed rate is higher than what your initial interest rate would be on the adjustable. But that isn't always the case. It really depends on market conditions. But when it comes to the adjustable rate option, the interest rate is actually made up of two things added together. The first piece is something called the margin. This piece of the interest rate is actually fixed and cannot ever adjust. The second piece that is added to the margin is called the index. The index is the part of the interest rate that would be able to adjust once a month with the market. Add those two pieces together and you have your total interest rate at any given time. So if you have a reverse mortgage already or are ever proposed a reverse mortgage and the interest rate includes a margin or an index, you know that is an adjustable rate. Now, as far as the amount of money that you can receive, the reason in many cases why the fixed option doesn't provide for as much as the adjustable option is twofold. First, if the fixed rate is higher than the expected rate on the adjustable option, your total maximum loan amount will be less. The reason for this is those rates determine how much you qualify for. The higher those rates, the less you qualify for, and vice versa. The lower those rates, the more you qualify for. And to be a bit more specific, when you go to get a reverse mortgage, your age and the long-term interest rate for whatever loan type you are considering will determine what percent of your home's value you qualify for. That percent is what changes when the long-term interest rate is higher or lower. So for one option, you may qualify for 50% of the home's appraised value. And for the other option, if the long-term rate is higher, you may only qualify for 48% of the home's value. Next, you may receive less proceeds in the fixed rate option because of how the federal regulations require any money you have within the loan be dispersed to you or not dispersed to you. Let me give an example of what I mean by that. Again, your age and long-term interest rate of whatever loan type you are considering is going to determine what percent of the home's appraised value you qualify for. Let's say the percent of what you qualify for is 50%, and your home's appraised value is $100,000. So 50% of that is, of course, $50,000. That $50,000 represents the maximum amount that you can receive from the reverse mortgage loan. Now, first things that have to be paid for out of those funds are any mortgages that you have and closing costs for the loan. So let's say in our example that the mortgage and closing costs equal $25,000. That would mean $25,000 of the $50,000 total is paid out, leaving you with $25,000 left over. The leftover $25,000 is where things get different when it comes to the fixed versus adjustable rate options. More specifically, the federal regulations for this loan will not allow lenders to just give you all of that leftover money at one time in many cases. Depending on how much money is left over after any mortgages and closing costs are paid, there is a limit to how much of the remaining funds you can access within the first year. So when you have a certain amount of proceeds left over after your mortgages and closing costs are paid, in some cases, only a portion of those proceeds will be immediately available to you. And the amount that is unavailable at first will become available to you after you've been in the loan for 1 year, and only if you have chosen the adjustable rate option. To say this a bit differently, if the numbers work out to where you have an unavailable amount of money in the first year of your reverse mortgage loan, that unavailable amount will never become available to you in the fixed rate reverse mortgage option. The reason for this is because of the third difference between the fixed and the adjustable rate options, and that is the line of credit or lack thereof. As I said before, the adjustable rate option is the only option that comes with a line of credit feature. When you have an amount of proceeds that is unavailable to you in the first year of the reverse mortgage, 1 year after closing the loan, the unavailable amount will become available to you in the adjustable rate line of credit. And because the fixed rate option does not have a line of credit, this is the reason that money just simply never becomes available to you. Essentially, with the fixed rate option in this situation, that money is just equity that you won't ever get access to. And just to be clear here, though, it won't be added to your loan balance or anything like that either. Bottom line, this is the biggest reason why, in most cases, the adjustable rate option will give you access to more money than the fixed. It is due to this that the fixed rate option becomes even less palatable to many people. Lastly, because of the line of credit feature in the adjustable rate option, this gives a few more benefits over the fixed rate option. For instance, the amount of money you do have available to you at the closing of your fixed interest rate reverse mortgage, if you don't pull all of that money out at closing, you can't come back later and get the rest of it. Because of this, most people just wind up taking whatever they have access to, even if they don't need it. And the downside to this is, even though you didn't need it, that money starts to get charged interest because you pulled it out. And you pulled it out because you didn't want to lose access to it. Now, compare that to the adjustable rate option, whereas any money you have immediately available at closing, if you don't need it, you can keep it in the line of credit. And the benefit of doing this is, one, you don't lose access to it. It'll always be there for you to withdraw from. Two, you are not going to get charged interest on the money you leave in there either, because you haven't used it yet. And three, the money you leave in that line of credit will actually begin to grow immediately. And it will grow at the same rate that your loan balance is being charged for interest plus 0.5%. Now, that is the short and sweet version of the line of credit, but go check out my other videos on this if you want to learn more about this feature. It is probably one of the most advantageous features of a reverse mortgage. So because of this line of credit, in many cases, it gives you access to more money, doesn't force you to withdraw anything from it, and actually rewards you for keeping money in it by saving you on interest and having the money in the credit line grow. With all of that said, there is no doubt that the line of credit that only comes with the adjustable rate reverse mortgage provides for many more benefits that the fixed rate option simply can't touch. These are the reasons why most reverse mortgages wind up being adjustable rate. But as I said before, no matter what, this is your decision to make and yours alone. And the numbers don't always wind up being that drastically different from the fixed to the adjustable rate option. And in those cases, some folks choose the fixed rate option, understandably. As well, even if the numbers are drastically different and the adjustable rate option does provide you with more benefit than the fixed rate option may still provide you with what you need. And if you get more peace of mind with that interest rate being fixed, then you may still want to go with that option. Either way, it's always good to understand both of these options in their entirety. And if you are a regular viewer of my content, you know my biggest piece of advice is to soak up as much knowledge about this product as you can so that you can make the most well-informed decision at the end of the day. And those decisions include, number one, whether a reverse mortgage is even a good fit for you or not. And number two, if you feel it is a good fit, understanding the ways in which you are comfortable having the loan structured. And lastly, having confidence in those decisions. So if you found this video helpful, again, hit that like button and subscribe to the channel. And if you have any questions about today's topic or about reverse mortgages in general, I'm always here for you. You can reach me at 888-982-0475. Take care, everyone.